The first quarter of 2023 was marked by unexpected events, including a sudden increase in month over month CPI growth and challenges across the banking system. The Federal Reserve's hawkish monetary policy has been stubborn but also adapted to some of these challenges. Meanwhile, the labor market remains strong and consumer sentiment is improving, especially for lower income households. Moody's latest baseline forecast predicts no recession in 2023, although the probability of one is increasing. Even in a more optimistic scenario, we expect sluggish GDP growth and higher unemployment or a slow session. This year, the office sector will be in the spotlight due to remote work, operating cost management, loan refinancing or default risk, and the flight to quality trend. However, this also creates opportunities for reevaluating and reinventing office spaces. Multifamily should remain relatively stable unless the labor market significantly deteriorates or the single family housing market rebounds strongly. Rent growth will normalize around 3%, and vacancies may increase further due to high volumes of construction deliveries. Retail is currently balanced, but transformation and revitalization will continue. Metros that have experienced exceptional growth in the past 3 years may experience bigger slowdowns or even corrections, but this should give other parts of the country time to catch up, as long as we avoid any major downside systematic risks. Demand for office space continued to decline in quarter one as companies adjusted to hybrid models and strategically consolidated real estate space to improve operating margins. Naturally, more than 5 million square feet were released back onto the market in the first quarter. Meanwhile, construction slowed further with just over 3 million square feet of new space delivered in Q1. Vacancy rose to 19%, up 20 basis points from the previous quarter due to the oversupply and exceeding the pandemic peak of 18.5%. Office vacancies have risen for the fifth consecutive quarter, bringing it closer to its historic peak of 19.3% in 91. Asking rents increased by 0.4% in quarter one, despite the rise in vacancies, likely due to inflationary pressures. The pandemic has accelerated market trends regarding how and where we work. Hybrid models have become widely adopted, though significant portions of the market remain either entirely in person or remote. With individual firms adopting competing models for specific business needs, a universal standard has yet to emerge. 2023 is poised to be a year of adaptation or even innovation as firms weigh their choices among location, size, and amenities, given an increased availability. Retail was hardest hit during the great financial crisis of 2008. Oversupply and 3 years of negative retail net absorption increased the average vacancy from 6 to 7 to 10 or 11%. Since then, several factors have weakened supply growth. Developers have become more cautious, demand is dampened with the rise of e-commerce, and consumer preferences have gradually changed. COVID-19 and the upsurge of remote work have exacerbated retail woes, but this shock did not cause a free fall similar to the GFC because the sector was already struggling in the decade leading up to the pandemic. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281 222 0433. I appreciate your time and have a good day.